Good morning, everyone. Thank you for joining us today. I'm Paula McCain. I'm one of the business advisors here at the North Central Texas Small Business Development Center. Today's not only election day, didn't know if you realized it, it's National Candy Day. So now I have an excuse to eat chocolate. The SBDC is a leading provider of assistance for small businesses. We are grant funded, and because of that, we are able to offer our services and resources to you at no cost. Today's presentation is the personal side, personal financial statements, credit report, and income information, looking at it from a loan perspective. Quick reminder, we are recording this, so the webinar will be added to our YouTube channel. Our presenter today will be answering questions throughout the webinar. And let me introduce her. Our presenter today is Karen Thompson. Karen has been an active commercial and SBA lender in the DFW market for over 25 years. Before becoming a bank lender, Karen worked in a family-owned business where she acquired her street MBA. I'm interested in hearing more about that, Karen. Karen is passionate about helping every entrepreneur become more successful in running their business. She believes that teaching business owners how to understand their business and personal financial statements and use them as decision-making tools is an important part of helping entrepreneurs succeed. And she's one of my favorite people. Welcome, Karen.
Ditto. Thank you. It's nice to be here this morning. And I have worked with the North Central Texas SBDC office for years. And when I was an SBA lender, they were a wonderful resource of very well prepared, primarily SBA loan prospects. And we've done multiple loans together and watched these people grow and thrive. And that's been a great joy. And now, since retiring from that and doing some business consulting, I love partnering with them, every one of them. And we've had some great meetings with some of their clients. And it's just part of that joy that we share of helping small business owners figure out what's going on, help them move forward, not necessarily get a loan, but just to understand the strengths and weaknesses and of their statements and understanding them, and also help them with marketing and HR and AI and everything you can think of. So it's a partnership that I love working with very much, and I'm looking forward to doing this today. So let me start sharing my screen. Do you need to stop sharing first?
I've already done that.
You did. Okay, here we go. Let's see here. So my goal today is to help you understand the banker's perspective. We've already talked about that. Yes, use them all the time. And there'll be situations coming up as we're talking where I go, okay, I met with the SBDC about this. But my goal today is to pull the curtain back and help you understand why you have to give so much information, what they're asking for, how they look at it, what they do with it. And it's not just the bankers. You can think about this in terms of if you want to sell your business or you're getting investors or anything like that. So we're going to talk about, we have 5 of these scheduled. And whether you're asking for a business loan or just a personal loan, like a mortgage, you are always going to have to share your personal financial statement, your personal income information, and then the bank will pull a credit report, and we'll talk about how the bank looks at that. So that's why I'm starting with personal, because it impacts business credit and personal credit. The next one will be about the business balance sheet, and that's always the first document I ask for. And I'll tell you why that's significant. We're going to talk about the business income statement and look at cash flow and how we kind of look at the repayment ability. We're going to talk type of business loans and when to use them, and probably an emphasis on SBA loans because that's where we have a lot of common partnerships. And then we'll do a course summary, and we'll look at a mock loan committee and see what y'all decide about whether or not we should make a loan. So let me give you the context in the banker's head of where we're coming from. when we make loans, we're not making loans with the bank's money. A lot of times people think, they won't make a loan for this or that reason. But the money that we loan to people is your money. It's your deposits, your personal and your business checking, CDs, all that stuff. We take the money in the front door and we put it out the back door to loans. So we have a huge fiduciary responsibility to do very thorough due diligence and make good defensible loans that have a high repayment ability. So we take a look at all of the subjective and objective information that we can collect. So this right here is a typical needs list that a bank is going to ask you for. They want 3 years of business tax returns and all the schedules, not just the front pages, but the whole thing. Then they also want 3 years of business financial statements. Often people would just send their P&L, but that balance sheet and P&L go together. So 3 years of that. Then a current interim balance sheet and income statement. And if it applies, an AR aging, an AP aging, and maybe, depending on what you're doing, a pipeline report or some projections. And then on the personal side, 3 years of tax returns and a personal financial statement, and we'll pull the credit. And the reason why we want 3 years and we go back is that we're looking for consistency. We're looking for trends, because all of that matters in when it comes to figuring out repayment ability. So I know it's invasive. It feels very invasive. It is. But in the back of our heads, again, more context to the situation, businesses can fail or just have difficulty repaying a loan for some of these reasons. Poor cash flow management. You're making sales and it looks like on paper you're making money, but where's the cash? And we have to figure that out. A lack of market demand. Some people fall in love with their product, but the world doesn't, or trends shift. And so we kind of look at that situation. Pricing mistakes. It's more common that small business owners will underprice their product or service just to get market share, but that's not necessarily a good long-term plan if they're not profitable. The owners have inadequate financial literacy, which we're talking about today, and they need to be used as business decision-making tools. I'll give you a quick example that I had with Paula recently, where we had someone who is in the retail services business, and they, over the last 4 years, they had grown a lot. In fact, I took notes. They grew their sales 63%. Excellent marketer, networker, active in the community, doing all of that, just killing it with the sales. But they went from making about $40,000 a year to losing $8,000 a year, which didn't make sense, right? Because you're a business owner, you're thinking we're killing it. What's going on? So we drilled down deeper. We met with the client in Paula's office, drilled down deeper into his financials, and it told the story that all of a sudden his labor cost went from 40% of sales to 75% of sales. So just spreading out the financials and looking at them like that, it told the story that, hey, this is where this is happening, what's going on. We talked further and got into the process and operating and started to understand why. So that was a super valuable example, and why you should call your SBDC and work with the analysts, the financial advisors, because they can help you walk through that process. Then we have unreliable financial statements. That's different. I had a client call me one time. He said, I'm killing it this year, Karen. It's just crazy. I'm just so excited. I'm having such a good year. Calls me. I'm like, great, that's fantastic. Why do you think? And he's like, I'm not sure. He calls me back 2 weeks later. He's like, not so great. My bookkeeper forgot to load into QuickBooks 2 months of business credit card expenses. It's like, no, it's not such a great year. It's an okay year. So it's really important that you keep current, detailed, all information in your statements so that you can use them as decision-making tools. You have changes in technology that happen around you, or personnel. You can have changes in the laws. Like recently, people are questioning, what are the tariffs going to do to this or that business? The economy changes. Lawsuits, you can be sued. You can make a decision to sue, which is expensive and drawn out maybe and not worth it, or maybe it is. Or even the lawsuit of a divorce can dramatically impact an owner and the company's business. And then the process and people issues, which is kind of what I was referring to when Paul and I talked with this one client. So that's why I'm explaining this, because I want you to understand that the banker is trying to look at all of this and how it might impact the repaymentability of a loan. And I want the business owner to see all this stuff too, to have a safe, reliable place to have this conversation. Okay. So let's start with the personal financial statement. This is a very typical standard thing that the bank's going to email you or hand you and go, okay, start here. So normally in a business situation, the owner's information is going to be in this top box, right? And then the spouse, if that person is married, the spouse's information is going to go in here. And then everything that goes on this personal financial statement needs to be, if you're married, needs to be the joint information. So a lot of people leave off the spouse, but this is in Texas, in a community property state. And when you're going to borrow money and you want to count all your income, and we need to understand cash flow, this needs to be completed by both parties fully. And I don't want you to stress about it. It's not hard. It is just take a deep breath and we'll just go through how to easily fill this out. These things are easy. You know where you live and what your birthday is. Now let's get to the assets. So this helps us understand the health of a business, where your net worth is, and how you can use this on an ongoing basis, like every 6 months or a year, just to check, where's my net worth? How is it building or not building? And helps you when you're thinking retirement. And you can do this in your 30s and 40s and just start gradually looking towards that day when you have the ability to retire or sell your business or whatever. So every bank is going to ask you for this. Include everything. So many times I would discover there's checking accounts or there's debt that wasn't on there, and they're like, oh, that's my spouse's, or I didn't think you needed that. And they're a little nervous to put everything on there sometimes. Just put everything on there. It just makes a comprehensive, good, thorough picture. I mentioned joint. And then do not, this is a very common mistake too, when you have a small business, do not commingle your personal assets or liabilities with your business ones. I've seen the business loan on the personal and checkings from the business on the personal, or just a mishmash. Those are two separate entities, and you need to keep separate financials for each one. So don't commingle that or put any business stuff on your personal financial statement. So you're just going to take a deep breath. Don't overthink this. You're just going to start listing your assets, what you own. And I know that your cash is going to change every day, right? You're using your checking account. Things are going in and out. Just pick a day, go through your bank, and just start listing. And I normally tell people on that form, just write "see attached" on there, and I will encourage people to use an Excel spreadsheet because it's easier to track and update and do the math and all that stuff. So you're just going to list your home, any rental property, cars, boats, ski jets. On these assets here, just pick a reasonable value. Don't overestimate anything. You can look at your property tax statement and see what the value is. Just pick a moderate value. Obviously, your cars and motorcycles lose value as soon as you walk out the door. So just be moderate on that. On your ownership interest in business, this is a perfect time to call your SBDC office because they have some nice tools to help you estimate what the value of that business is. So if you're 100% owner of something, you put 100% of that amount. If you're 50%, you put 50% of that amount. Just kind of gives us a heads up that, okay, they own a business too, or typically I would know that already. Okay, on the liability side, just pull up your credit cards. If the husband has one in one name, the wife has one in the other name, put them both on there. because we're going to end up pulling credit on both, and both need to be on the personal financial statement. So just gradually go through and just look up your balances, student loans, mortgage loans. If you have a home equity line of credit, include that. Don't overthink anything. It's not that hard. You're just going to list your liabilities. That's all you're going to do. So now you've listed your assets, you've listed your liabilities, and the difference between those two numbers is what your net worth is. Total assets minus total liabilities is your net worth. You can't guess your net worth. It is a math. It's a simple math problem. So when we're looking at that, we look at, well, this person may have a ton of assets, but how do they get those assets? Is it because they're up to their ears in debt, or is it because they have some debt, but they really paid for those assets over time out of cash flow that they have? So, and we're looking for a trend, and this is awesome for you to keep up with this and track it periodically. This is just a visual comparison of what would be a healthy versus an unhealthy. Assume they have the same exact amount of assets, same house, same cars, whatever, $1 million. The guy on the left, or the person on the left, has debt of $340,000. So their net worth is $659,000, which is feeling very comfortable. The person on the right has the same exact $1 million worth of assets, but their liabilities are $900,000. So they have a lot of debt service, a lot of payments. And so a banker notices that, okay, that's a lot of cash flow that they have going out the door to pay for all these assets they have. And if you think about like 2008 and 9, assuming a big part of those assets is a house, and your house tanks in value all of a sudden, now you're upside down and you have negative net worth. And if you lose a job in this situation, that's risky, because then where's the cash flow come to make all the payments on that $900,000 worth of debt? So that's kind of what the banker's looking at. And there's something called DTI we'll look at in a second, debt to income ratio, when you're looking at a mortgage. As a business banker, I never looked at that, but it's a factor. It's one of the little pieces of the puzzle that the banker's looking at to assess risk associated with repayment. So here, just to breathe, is just a simple example of, this is like an Excel spreadsheet. You're just going to list what you have, your brokerage accounts, you're going along contributing to your 401k, you got a car, a house, a lake house, some personal property. So this individual has 911, or this couple has 911,000 worth of assets. How did they get them? Well, $733,000 worth of debt is how they got them. So you can tell the lake house is kind of new because there's not much equity there. They pay down a little bit on their mortgage. They have a student loan that's hanging out there. So they have a fair amount of debt, and their net worth in this calculation, that's just math, is $178,000, right? So 10 years later, let's say this person is going along and kind of like, I would say, living beneath their means a little bit, because they're not spending every dollar they get. 10 years later, they can look at a much higher net worth. I barely nudged the value on their houses, just a tiny bit. But meanwhile, they've been paying into their 401k, never thinking about it. It's pre-tax money that's taken out, or they use it. They've contributed to their savings a little, so now they have $983,000 worth of assets instead of 911, but they have way less debt. They've paid down the student loan. Their credit cards run about the same. They like those points, so they keep their credit cards, use them. The auto loan is out there. The mortgage is down. The mortgage on the lake house is down. So now their debt's $526,000, and they have almost $500,000 worth of net worth. This is the trend that you're looking for, and you will see differences year to year if you are just kind of living beneath your means a little bit. It doesn't mean you don't go on vacation, go out to eat, but you gradually just focus on paying down your debt, building up your assets, And that is what you're going to get, is increased net worth. It's going to help you out in the long run. You're never too young to start this. While we're on this page, I want to mention the personal guarantee, because I don't know why people think they are not going to sign one. I've never worked at a bank ever where that was an option. If you're getting a business loan, you're going to sign a personal guarantee. And I think people are nervous that that means that we have a claim on all these assets. We don't. Unless you pledge and sign a security agreement for anything, none of this stuff is collateral for the loan. It is just, you're just saying, yes, I see this debt I'm going into, I'm behind it, and I'll take care of it. There's more to come about what you have to send us, but this reminds me of, I was in Pilot Point with Roger recently, and a lady asked, why should I go through all this trouble and send you all these business statements and personal statements and all this kind of stuff? The easy answer to that, he said, leverage. And I'm like, yeah, because you're going to put down, what, 20% of $1 million project, and I'm in for 800 grand, and you're not going to sign a personal guarantee and tell me, yeah, you know your business better than I do. You know your projections and cash flow and everything better than I do. I just want your name behind it saying, yeah, I have confidence I'm going to be able to pay you back, and I'll sign a personal guarantee. And you're not going to get the loan anyway if you don't. It's law in SBA loans and practice in every bank I've ever worked at. So I wouldn't sweat it too much. We're not taking a lien on all these assets. It's really just like giving your word. Okay. If you're doing just a mortgage loan, I never looked at this in the business banking world, but just to touch on this, since we're on the personal section, this debt to income ratio is heavily used by banks when you're doing a mortgage or a HELOC. And all they're trying to do is figure out how much of their income is tied up in hard payments. So they take, in this example, $6,000 of income, and they add up all these monthly payments, which they pull off the credit report and compare to your personal financial statement. Okay, student loan, car loan, blah, blah, blah. So their hard monthly payments, debt payments, are $2,350 against $6,000 in income, that eats up about 39% of that $6,000. Most banks set a cap around 36%. Some people are like real hardcore. If it's 36.2, no. The reason, and I used a bigger example, and the only reason is I was going to tell you that occasionally you can get past that if you have super good credit report and you have a lot of liquidity. Then they might go, okay, this guy has a lot of liquidity, we're fine, it'll mitigate a little bit that you didn't quite match that 36%. But I would say most of them probably stick to the 36%. So that just tells them the likelihood of repayment. Okay, anything on the personal financial statement? Okay, we will move on.
I have a couple of questions.
Okay.
On the guarantee, well, just one question. On the guarantee, does everybody on the loan have to sign a guarantee? Or
not everybody. Typically, this is what SBA does. It's a hard rule that if you own 20% or more, you're going to sign a personal guarantee. But there might be someone who owns 15%, but they're the president and they run the company, so our repayment ability is heavily reliant on their decision making and operation. So we might ask for a guarantee on that. Typically it's just 20% or over, or someone who has significant control over that business and the decisions that they make.
Okay.
Yeah.
Thank you. That answers my question.
Okay.
I had a quick question. On the credit cards, is this annualized, or is it at the moment they're applying how much debt they're carrying?
When you're filling out the personal financial, like on this line up here?
Yeah, the credit card Discover and credit card Visa, Is that something,
Yes, that's
like, is that an average that they're carrying per month, or is it at the end, at the time they're applying, this is how much is left as debt on their credit card?
I would say probably either one of those would be fine with me, honestly, uh, because I would say it does fluctuate so much. Like for me, I put everything on a credit card and then I pay 0 at the end of the month. So I would say you could do either one of those
Okay. All
because
right.
I'm going to pull credit on a certain day and it's going to have the balance for that day. So, and it may not be the same day you hand me your personal financial statement. So I would say average, outstanding.
Okay, excellent. Yeah, thank
Yeah.
you.
Uh-huh. Okay. Now we're going to talk about the credit report. Okay. So this is, I loved the credit report because it's the first third-party, data-driven, detailed document that we get that says how people handle credit out in the world. Because when someone comes into a bank and they want a business loan, I don't know them. They may have been depositors forever, but I don't know the ins and outs of their business. I haven't looked at their personal financial. I haven't looked at anything. But now they want a loan. So I need some type of outside input into my world, like how does this person handle debt? Because typically it's a 1 or 2 person owned or maybe 3 person owned business. And I'm going, okay, how they operate personally is highly likely how they're going to operate their business as well. So there's 3 credit bureaus, Experian, Equifax, and TransUnion, and they all have very similar scores. They all use the FICO score, and the numbers always come in very close to each other. And so, as you can see on the grading there, we would start looking at a loan at the good level. If you're in the fair category, unless there's a good story behind it, probably not poor is going to make it. Fair is probably not going to make it, but good is where I start paying attention. And I usually liked it over 700. Obviously, very good and excellent. We're looking at, but this is heavily relied upon in business banking and in personal banking because it's such a detailed and valuable tool for us to use and see how someone operates. This page I love because this tells you, everybody wonders what impacts my score, what hurts my score, what helps my score. The payment history is the biggest influence on your FICO score. That's just on-time payments, which is basically anything under 30 days. We'll go into more detail about that. The amount that you owe, how much debt you have out there, and how much availability you have out there. Those 2 alone are 65% of your FICO score. Length of credit history makes sense. It's got a smaller impact because if you don't have much, there's not much for the algorithms to generate any kind of input on. New credit I look at, and then the credit mix is 10%. So let's look at each one real quick. All right, this is the heavy hitter, the big one, the payment history. Late payments. I can tell on the credit report per creditor how many times you were 30 days late, 60 days late, or 90 plus days late. It counts that for me. So I can see a trend. If there's a lot of late payments, then I'm a little nervous. Why is that happening? And that dings your score a good bit. Bankruptcies, defaults, and collections, and even when you go to the credit consolidation people where somebody takes a hit, they negotiate something, it's on your credit report that that creditor did not get a full payment. They got a partial payment, but they settled. So bankruptcies, unfortunately, are almost always a deal killer. That just strikes fear in the heart of a banker. I mean, we're lending the customers money out there. And if we have seen a bankruptcy, it makes it very, very difficult to get another business loan. And those remarks can stay out there on your credit report for a long time. Maybe if it's very far remote in time, a banker will do that, but it was hard. I don't think I ever did a loan where there was a bankruptcy. The credit utilization, keep it low. Okay, I called it availability, kind of the flip side of looking at that. So here's how it's calculated, and here's what we like when the availability is high. If you had a credit card limit of $10,000 and you ran your balance around 3,000 or less, you've got 70% availability. I like that because that tells me that person is not maxed out on credit. I have seen credit reports where they had 4 credit cards of say $10,000 and they were all at the limit. I'm like, okay, that's a little bit of a red flag. Why there's no availability and they are maxed out on every credit card they have. So that's a bit of a red flag for a banker and need to have a conversation about that. All right, the length of credit history, you know, there's just no history there. I had a guy who had like $40 million in the bank and he was doing something and he barely used credit at all. His credit score was terrible. But he just didn't have any credit history because he just didn't borrow any money or, you know, he just paid for everything. So it was kind of funny that he had such a terrible credit score. New and credit inquiries. I do look at this at the bottom of the credit report that we can see, and I think the one that the bankers see is different than the one you can pull on yourself. They're similar, but they're a little different. I could see at the very bottom every place that person had gone to request credit or had their credit pulled by a bank. And if I saw like 4 or 5 banks had pulled credit in the last 6 to 9 months, I'm thinking, okay, why so many so currently? It's just a question. It's not necessarily a bad red flag, but are they going and getting credit at all these banks? Have they been declined at all these banks? Are they just shopping to find the best deal? I don't know until I have a conversation. But when I see a bunch out there, it does make me have a question about what they're looking for and what their experience has been like. And then the credit mix, small percent. They just like diversity of credit type. You know, they give you a little plus or minus if you have a variety of kinds of credit. All these institutions automatically send stuff into the credit bureaus, and so that's how it gets there. It's super automated. All right, so if you want to improve your credit score, pay your bills on time. Automate your payments, allow ACH, bill pay, whatever you got to do. If you need to make just the minimum payment, make it less than 30 days, because over time, that's because it's such a heavy hitter, that's gradually going to improve your credit score. Keeping your balances low and having availability. So there are some strategies where, and it may, I don't know if it's Dave Ramsey or not, or who says this, whatever, but people get in their head like, if they had 5 credit cards, okay, I'm going to pay them all off and close them all, not have one. I would suggest you have at least one and keep a super low balance so you have a really big availability, because that it carries a lot of weight in the algorithms for calculating your credit score. And then check your credit report. Mistakes happen all the time. You just challenge that charge and see if you can get it corrected. Which most time, if it's correct, that you know, you're right, they'll fix it. I would also encourage you to check your credit cards. Like 5 times in the last year, I've had charges show up that, like, that's not me, no. And I've won all 5. So while we're on the subject of checking the credit report, also check your credit cards, because those are get wrong as well. So any questions about the credit report?
I have a couple.
Okay.
Anybody else that wants to chime in, please do so. We often hear about business credit scores. Are those, I mean, how much impact does the business credit report have?
0, and I would consider that an urban legend. And the reason why is, back in the day when I first started, like over 25 years ago, we used to use Dun & Bradstreet. We'd look at it, which you might say is the business credit report. But that is on the personal credit report, you have no control about your auto loan and your credit card company and your bank and whoever sending information to the credit bureau, right? With Dun & Bradstreet, the business owner had to send information in, like self-reporting. Nobody did it. And it became just many, many years ago, a worthless tool. So in my opinion, as a business banker, commercial lender, we never, ever considered Dun & Bradstreet after like maybe my first or second year, just as a credit training tool, because it's not accurate. It's not thorough. It's nobody reports it. So it's not a real thing.
Mhm. What do you think about the different tools like Credit Karma?
I haven't used that. Is that a credit consolidation thing? What is that?
It's really not. It's part of Intuit. I think Intuit recently bought Credit Karma,
Okay.
but it's just a place where you can go and check your own credit. There
Oh,
are
for sure.
several different sites. You can check your own credit, see what's going on, and of course, they will be able to offer you uh, good deals on personal loans or credit cards or whatever, but you can check your credit without there being an impact on your score.
Yes, I would absolutely use that. I would pull your credit periodically. I see nowadays the credit card companies will tell you, by the way, your FICO score is blah, blah, blah. But if you wanted to see details, I would do it before you go to the bank. If you're going to ask for a business loan or a personal loan, I would do it. Um, Absolutely. Yes. And it really doesn't hurt your score very much at all for the bank to pull your credit. I have had people ask me, hey, can you not pull my credit yet? They send me the business information first. And if that's a no-go, then I don't need to pull their credit. But if I like the business information, I want all the personal stuff immediately. I really
Mhm.
want everything all at the same time. Some people they think it's going to hurt their credit score. It really doesn't hurt it very much at all for the bank to pull credit.
That's all I have.
Okay. All right. So personal cash flow and repayment ability. So we talked about the personal financial statement. You're going to list your assets, your liabilities, calculate your net worth. Then we're going to pull your credit report. And usually on those applications, those personal financial statements, when you sign, you're signing, you have my permission to pull my credit report. So then we're going to pull a credit report for both spouses, if you're married, or multiple owners, if there's multiple owners. And we're going to compare, like, okay, this is all the debt I see here. This is all what you told me about. And usually those match, but sometimes they don't. And they'll go, oh, that's, I let that off, whatever, honest mistake. So we make sure we have a comprehensive, full picture of what all the debt service is. And the income numbers that we use, because it's the most reliable and the most formal, is the personal tax return. That is we do something in SBA lending called global cash flow, because there's so much fluid movement of cash sometimes between a business and a person. I want to see the personal tax returns and the business tax returns, and we'll look at the global cash flow. Because we'll compare all the personal income and all the personal debt to all the business income and all the business debt, and go globally, even though they may move money back and forth a little bit, are we good? So if you do not have your tax returns done, you are dead in the water and there's nowhere to go from here. And I know it's hard to keep up with that, especially when you're a small business. But my biggest advice there that a lot of people just really need to do is don't commingle anything. Have a separate business credit card and a personal credit card, and don't intertwine those, because it's a nightmare to figure out and do your tax returns. You're just creating trouble for yourself. Keep separate checking accounts from the get-go, from the very beginning. And then it's very easy to track business and personal stuff. So We use the business tax returns, the whole tax return, all the schedules. And if there's issues on any of this stuff, we can always ask questions. I did add a picture, I think, yes, and I'm sorry, this is a terrible scan, but this is a copy of a Schedule C, which is part of the personal tax return. So this is the name of proprietor. And some of these can be filed with your social security number, or you may have an EIN number for your entity. This is your small business that does not file an 1120S or a partnership tax return. This is if you are eligible to just file Schedule C and do a P&L basically for that, because this contributes to part of the income that we're looking for, business and personal, to repay a loan. So all it does is just walk through the gross income, all the different sources of gross income, and then this is just like a little P&L. You list all your expenses, depreciation, obviously we add back because it's a non-cash expense, but this just kind of tells us a story of the personal business that you have. Your CPA probably does this, but you give them the information to do that. Hopefully you have a bookkeeper or you're keeping up with it. But when you have clean credit card statements and clean bank statements, this is not that hard to do. And then it comes down to a net income number. And I did not actually load the K1. I can add that later, but that is a partnership addendum that it gets added to the 1040, and then we can see how much income they made or lost, and then how much cash they took as a distribution, because not all the income is necessarily it's taxed, but it's not realized by the individual as part of their cash flow. So it's a comprehensive personal tax return that may include this Schedule C and a K1 if they're part of a partnership. And so the point is, all of these things are important to keep up with and to give to the banker all the schedules and everything to get to your personal cash flow. Okay.
I had a quick question, Karen.
Yes.
When we're talking about qualifying, right, in that ability to repay, I work a job and I'm trying to open up this business. Should I be keeping my job to help pay, or can I just quit my job and then go into the new to do it? It looked like maybe some of that qualification was built in for me to kind of keep working to make sure that payment can be made.
That is a really good question, and that's kind of a catch-22 question, because there's a part of the banker that goes, man, I need you all in, and focused on this. And another part that goes, I can't. The alternative is if you quit your job and you're working on just projections. Projections are inkjet on a piece of paper, right? Maybe they'll happen, maybe they won't. We hope they do. So I've done it different ways. Somewhere a spouse works, another reason to have for me to count all the income in the cash flow repayment. That's why to count all the income for both spouses, if they're both working, that's why I need joint everything, joint credit pool, joint personal financial statement, and joint tax return. Because I can work into the cash flow the spouse's income from their other day job. Here's the new person that wants to start a business. So in that global cash flow, is there enough with this person working? And if the projections don't work out exactly with the new business, is there still enough cushion there that they will be able to cover all their expenses, the new business loan they want, plus their personal debt service? Does that make sense?
Yeah, perfect. Thank you.
Okay, yeah. So it just depends. Sometimes it's that's a hard one for people to take that step off. It really is. But we do like them to have time to work in the business, right? Because we need them to be making money. Okay, anything else? This is the summary of the key points I want you to remember. take a breath when it's time to fill out your personal financial statement. Just get an Excel spreadsheet, list your assets, list your liabilities with knowing your payments, and then assets minus liabilities is your net worth. And then once you get that Excel spreadsheet set up and started, check it. It's kind of encouraging, to check it maybe every 6 months or a year. If you're married in banking world, include assets of both spouses. Credit reports will be pulled on both spouses, and income will be counted for both spouses. Don't commingle personal information with business information on your personal financial statement. And then, like I said, check your net worth annually. On the personal credit report, the two biggest things that you can do to have good credit is keep your payments current, set up some automated method of doing that, avoid bankruptcy, and then keep your credit availability high by having at least one credit card or two that would have a high credit limit and a low balance. And then check it for errors periodically and dispute anything you think is wrong. On the income taxes, just stay current. I have a dear friend who's she's got multiple businesses, so it's really hard. And I know it's hard, but if you want to attract investors, if you want to get a loan, if you want to get a mortgage or a business loan, that's ground zero, those tax returns. So you need to keep those current. All right. That's everything on the personal. Any more questions about that? Okay. Well, that seemed like that went by fast. Next week, we're going to talk about the business balance sheet, why it's always the first thing I look at, why it has influence. Sometimes people just gave me the P&L. I'm like, nope, I need that balance sheet too. Because just like the personal financial statement, it's from the day you start a business until this very day, what kind of net worth and what kind of strengths and weaknesses do you have in your balance sheet. And I highly encourage anybody and everybody to pick up the phone and call the North Central Texas SBDC, or if you live in a different county, call them, because they're experienced business owners. Sometimes they have talked to so many business entities. They are confidential, they're free, and it's just a safe place to just go, here's my stuff. Help me understand my financial statements. We've had lots of good calls that help people learn and make good decisions from having a place to brainstorm over those numbers and figure out possible operational changes to make, staffing changes to make, just different ways of doing things that help them be more successful. So that's it for today. I'll stop sharing. Come back to y'all.
Well,
Any more
I'm
questions?
going to go ahead and share my screen. Does anyone have any questions? This is such good information. I am loving it. I learn so much whenever I talk with you, Karen, all the time. I do appreciate you.
Thank you. Same. I love working with you and your clients.
Oh, yeah. We appreciate all the help that you give us. We really do. Just want to point out that we have some upcoming webinars, and on your screen, you're going to find as many as I could get on this one slide. There's more. We're pushing it into December for our different topics, but here's what's going on tomorrow. How to protect your smartphone. We're looking at it from a cyber security perspective. We'll have Andy Singleton coming in to do that. Then Thursday is a heavy day. We've got 2 back-to-back webinars on continuation of our QuickBooks. And then Randy Dean, he's coming in and giving us some ideas on how to better use the cloud tools that we're all of a sudden starting to get on our Microsoft Outlook and Google and stuff. Then we have HR and other things coming up. And next Tuesday, we have Karen back for the business balance sheet and how to understand and read those documents. So looking forward to everything coming up. Just want to point out also, if you want to register for those webinars, you can go to our Eventbrite page, or you can use that QR code in the upper right-hand corner that will take you to our website where you can also register for the upcoming webinars. On our website, you can register for those webinars, but you can also get contact information. You can schedule an appointment with an advisor. And we also have resources on our website that small business owners can utilize, therefore, again, at no cost. And I want to thank our benefactors, since we are grant funded and we can offer our services and resources to you at no cost. I want to thank the people that make that possible. The Small Business Administration, the state of Texas, at the North Texas SBDC Regional Office in Dallas, and our host institution, North Central Texas College. I want to thank everyone for joining us today, and I look forward to seeing you tomorrow as we all learn how to protect our smartphones. This will end the webinar, and look forward to next time. Thanks so much, everyone.
Thank you.